Well, good morning and welcome to the Small Business Seminar, How to Obtain Financing to Help Your Business Grow, presented by Central Pacific Bank. My name is Shireen Urakami Oyama, and I have the pleasure of serving as your moderator for today's session. At Central Pacific Bank, we continue to believe a rising tide lifts all boats, and we are committed to the financial health of our community. With that in mind, we launched Rising Tide. And Rising Tide represents our belief that there is strength in partnership, and it is our hope that through Rising Tide, you will find resources to help your business and harness the power of community. I know we have some Rising Tide members on the webinar today, so a special good morning to you all. And we hope that all of you who are not quite members yet of Rising Tide will consider joining this special community of small business owners. Before we get the program started, I wanted to go over a few housekeeping items. So the first is that the session is being recorded, and a copy of the recording will be made available to all of you a few days following the event. We will have a Q&A discussion at the end of the two presentations, so please feel free to submit your questions through the Q&A button. And now it's my pleasure to introduce to you our esteemed panel. On today's panel, we have two experts in their fields who have a deep knowledge of what it takes to build a business through creative financial planning. We have Cynthia Yamasaki, Oahu Center Director of the Hawaii Small Business Development Center, and Mr. Michael Kim, Vice President, Business Banking Team Manager at Central Pacific Bank. We're looking forward to discussing some key topics with them as it relates to how businesses can put their best foot forward in our ever-changing economy. So at this time, I'd like to turn it over to Cynthia.
Thank you, everyone. I was muted. Good morning. Thank you for joining us. Nice to see so many people online. So as Shireen said, this webinar is about how to obtain financing to help you grow your business. And my portion is to help you to prepare to meet with your banker. Before we get into that, I'm Cynthia Yamasaki, and I've been in business or in this business community for many decades. And I'm very pleased to be part of the Hawaii Small Business Development Center. So we've been in Hawaii since 1990, so over 30 years. And we have offices on all the islands, Kauai, Maui, Hawaii Island, both in Hilo and Kona, and on Oahu. So our mission is to really help businesses, small businesses and medium-sized, to drive the economic sustainability. And we work with you to help you form, grow, and thrive. So last year, we helped small businesses to work with you, which I'll share in a bit, to gain $36 million in access to capital. And 98% of the businesses in Hawaii are small, and we work with you one-on-one. It's a relationship, an ongoing relationship that we have clients that we've worked with since they started, and others just joining in when they find a pinch, like now, how to recover from COVID, or if they want to take their business to the next level. So when we say we serve statewide over 1,000 unique clients, you are unique, and that just means we work with you, but we work with you ongoing. We are funded by the Small Business Administration and also the state of Hawaii. We're part of a program that is sponsored by the University of Hawaii in Hilo, and we're part of a large network of other small business development centers across the nation. There are over 1,000. And so there are some people who might be expanding their business or relocating, then we can reach out to the network on your behalf and introduce you. So what do we do in the context of what we're discussing today? How do you get finance? Preparing for that. So in the end, to prepare to meet with your lender. So that means working with you on your business plan and your projections to determine what is it that you need and how are you going to repay that. That's the main message that you want to convey to your banker. And so many people say, really, when I first started my business, I just have a one-pager or I have it all in my head. But at this point in your company's growth, it is very important to have a business plan, whether you are going to present it to other investors to gain funding or get a bank loan, and even for yourself as your business, for your business and for your employees, to communicate what is your strategy, what is your strategic plan, and how does it affect all the areas in your business. Is to identify the future possibilities, evaluate your strategies, create a management tool, and really when you go to see your banker, you can say, this is what I need, the amount, what it's for, and my projections, so that I can assure you that I'm going to pay it back. On my next screen, I have an overview of all the elements of what we call a traditional business plan. There are many apps and things out there now that for entrepreneurs that they can do a simplistic plan, but you have to remember when you're working with a banker, and especially if you're going to be applying for SBA Guaranteed Loan or any more details are needed. So these are the 9 areas. I'm not going to go into them in detail. However, your handouts will have this information with some links of other resources that you can use to help guide you about what should be in each component. And in addition, at the end of this session, I'll give you some information how you can contact us to help you and guide you to give you feedback and perspectives on your business plan. One of the things I wanted to highlight is when you're doing your business plan, you're really thinking about what is your value proposition? What is your business idea, and how do you validate that? So really, you're telling your story in your business plan about where you've been, how are you doing financially, and where do you want to go? And so in that future growth, to get financing for it, it's looking at this process of always checking to see who is and identifying who is your target market, who's your target customer, what is a problem that you're solving and your ideal clients. And then the proof of concept, if it's something that you're going totally different, like a real pivot in your business or branching off into a new area, then you want to have in your business plan really good information, some data on the industry, on the market research, what's happening in the market, perhaps even customer surveys or prototypes, and even maybe results of a pilot to really say, if I'm going to borrow 500,000, 1 million, 2 million, or even 50,000, it's debt that you're getting into. So you want to test it and say, all right, I'm going to feel confident that when I grow my business in this way, that it's going to realize the outcomes that I'd like to see and be able to repay the loan as well as make a profit. In addition to target market and your proof of concept, it's taking a step back and say, why would my customers want to choose me over my competition? So it's not necessarily saying I'm going to be like the competition or beat the competition. It's really what is your uniqueness, and really taking a step back and looking at that. And that value proposition is where that comes in, and it goes nicely and falls in nicely into all of your marketing and branding plans. So really it's about nowadays when you're looking at your business and you're looking at providing jobs, great opportunities for growth for your employees, as well as servicing and filling the needs of your customers, that's your value proposition. The other part of your business plan that we would really work with you and help you is to take a look at your financials. Before you meet with the bank, review how you've been doing financially for the last 2 to 3 years, looking at your balance sheet, your profit and loss statement or your income statement, and your cash flow. And then we help you and point out things to speak in terms of the numbers that your company has demonstrated to show how is it growing, What are the reasons for the changes in your revenues and your expenses? And understanding what these changes mean in terms of liabilities and the impact to your value of your company or your retained earnings and your value. So when you get a good grasp of your business, you don't have to know it in terms of exact ratios, but it's good to have that knowledge and that awareness. So when you meet with your banker, you understand where they're coming from and can provide all the information that they need to analyze your request. Here's an example, and it's kind of a small print, and I'm not, depending on how you're viewing this, don't worry. I just wanted to show an example of when we say looking at your cash flow statement and we're talking about projections. It's a bit more than what you might print out from your QuickBooks report in terms of cash flow, or even looking at the overall way of people. Sometimes people will take their net profit and add back the non-cash items. When we're looking at your business plan, growing your business prudently and with confidence, we're saying know the cycles of when you receive money and when you need to pay out money. So a good way when you're looking at growing your business is to do a Performa statement month by month for at least a year. And it's going to list out all the things that you have on your income statement, the receipts and the payments. And based on where you want to take your business, you'll have assumptions made that will be detailed on how you came up with these figures. And again, don't worry, we'll have handouts and resources to help you if this is something that sounds Greek to you right now. You can also engage the help of your accountants or CPAs so that the information that we use to do these projections will be a good solid baseline. So it's very important to keep good record keeping. So as I mentioned, when you do the Performa, once you see when your receipts, it's not only the amount but the timing of it, then we can calculate what is it that you really need in terms of the amount that you need, and are your projections realistic, and if you're providing the backup information. And then, as I mentioned, doing it for the first year, month by month. But as you project out for the next 2 to 3 years, then you can do some annual projections. This will help your banker know that you've thought it through and where the sources of repayment can come from when you borrow for your business. And again, I want to reemphasize on this that there are resources for you on SBA.gov. They have a business guide and online learning, really great courses, self-paced courses and examples that you can use. We will provide for you a template that you can use for the business plan. It's a Word document, and also an Excel spreadsheet to do your financial plan projections. And when you gather that information, you can meet with us and we can guide you. Let me just explain. We don't write it for you and we won't calculate it for you, but we would teach you how to do it, what to look for, and give you feedback. So together, we're helping to strengthen your business acumen. So we would gladly welcome to help you. We provide no-cost one-on-one advisory services, training, workshops, and webinars, and other services. If you want to meet with us to discuss and prepare yourself for applying for financing, then we would ask that you would come and register on our website, which I'll show you in a bit, and be prepared to provide us whatever you have written in terms of your business plan and your financial projections. 2 years of your business tax returns and a current year-to-date internal prepared income statement and balance sheet. And depending on your situation and why you need the funds, there may be other information that we'll request from you. So when you meet with us, we'll take a look at that, give you feedback. To sign up, it's very simple. Just go to our website, hisbdc.org, and at the top of the homepage, you'll see this green bar that says sign up for no cost advisory services. You click on that, and then it'll ask you for which island do you want to do your business, or which center. And that is based on where your business is located, your headquarters or your main business. So if you are located on Maui, you would then select Maui. If you're on Oahu, select Oahu. And then once you get to that screen, there'll be a list of information that we collect, and that is because we are funded by the SBA and through other federal and state funds, we like to keep track and make sure that we are working with you, know what your business is about, some information that's all kept confidential. Once we receive your completed registration form, you're held back from us to schedule your appointment. So with that, that's the end of my presentation, and I will stay on so I can answer any questions that anyone would have. Thank you.
Thank you so much, Cynthia. And I made a boo-boo. I didn't do my proper introduction of Cynthia. I was so eager to hear her presentation, but we're very fortunate to have her because she has really more than 3 decades of business experience with expertise in leadership, strategic planning, finance, human resources, and customer service. She worked her way up from entry-level box office cashier to senior leadership roles in financial institutions, corporations, and nonprofits. And as a bonus, she is also a small business owner since 2007. So a great resource for everyone. I hope you will all reach out to Cynthia and her team for assistance. Our next speaker is Michael Kim, Vice President and Business Banking Team Manager at Central Pacific Bank. Mike has over 13 years of banking experience and has been with Central Pacific Bank since 2008. Michael has a Bachelor of Science degree in Business Administration with an emphasis in finance from the University of Hawaii at Manoa, and also graduated from the Pacific Coast Banking School. Michael is a board member of Aloha Medical Mission and serves as treasurer and is a member of the executive committee. Thank you, Michael.
Thank you, Shireen. And thank you so much, Cynthia. That was excellent and very thorough. Now that Cynthia has gone over what should be included in your business plan, for the next section of how to obtain financing to help your business grow, we'll go over what banks consider when reviewing business loan applications. I am happy to be presenting on behalf of Central Pacific Bank. As a member of the Business Banking Division at CPB, our team helps business owners achieve their goals, which includes obtaining financing to help their business grow. Before I begin, I would just like to share a little bit about Central Pacific Bank. So since Central Pacific Bank was founded in 1954, Central Pacific Bank has been committed to helping small business owners, and this commitment continues through today. Over the last 2 years, we worked around the clock to help over 7,200 small businesses obtain over $569 million under the SBA's PPP program. CPB processed the highest percentage of loans for its home state, more than any bank in the country. We helped as many businesses as we could, whether they're a CPB customer or not, which really shows our commitment and dedication to Hawaii's small business community. Now, as businesses are pivoting to adjust to the new economic climate that we are in, most businesses are looking to grow in this new environment. Growing your business usually requires an injection of money, and there are various sources of capital, some of which Cynthia has mentioned. You, as the business owner, can lend personal funds to your business. The business could also use trade terms from suppliers and vendors. Now, sometimes the suppliers will offer you 15 or 30 days to pay them back. The business could also bring in investors, but you will give up a share of ownership and or profits by doing so. Or you could borrow. And typical places that businesses borrow from are family and friends, credit cards, but these are very expensive, which with interest rates as high as 20 or 30%, life insurance cash value, and retirement plans, but these are not recommended borrowing sources as that is not what they were set up for. Or you could borrow from a bank, which is what I will be talking about today. So what do banks consider when deciding to lend to a business? I'll be going over the 5 C's of credit, which are the fundamental principles lenders consider when making a decision to lend. So the first C is character. Character is the willingness of the owner to repay the loan. The owner's credit score will come into play here because history is a good predictor. And this is the measurement that banks use to gauge the probability that the owner will keep their commitment. Now, typically, any owner with 20% or more ownership in the business must provide their personal guarantee to repay the loan to the bank, and their credit history will be considered. So it is very, very important to protect your credit score. Character also includes the owner's industry knowledge and experience to successfully operate the business. The second C is capital. Capital is how much personal cash that has been invested in the business, as well as yearly profits that have been kept in the company. Banks want the owner to have some skin in the game. So when the owner invests their own money in the business and keeps the yearly profits in the business and doesn't spend the profits for expensive personal things, it shows the business owner's commitment to the business and willingness to take on personal risk. A good net worth position shows the bank the business has a strong financial condition and cash reserves to lean on in times of economic stress. The third C is capacity or cash flow. So cash flow is what repays the loan. Your cash flow needs to cover all business expenses and debts comfortably with cushion, as well as the owner's pay to support their personal expenses and debts, also with a cushion. Cash flow is the primary source of repayment. Banks measure cash flow with a debt service coverage ratio, which I will cover following the 5 C's of credit. The fourth C is collateral. Collateral is what secures the loan, and it is considered a secondary repayment source. This is typically the assets of the business and in some cases the assets of the guarantor. The fifth C is conditions. This is relating to the condition of the industry and the overall economy. These external factors could impact a business positively or negatively. For example, the conditions are unfavorable today for a high-end restaurant opening in Waikiki. So, as I mentioned in the last slide, banks measure capacity or cash flow using a debt service coverage ratio. This ratio helps banks to measure whether a business and its owners have enough cash flow to cover business expenses, personal taxes, and all business and personal loan payments with a comfortable cushion. The first step a bank will do to measure cash flow will be to calculate EBITDA. This is calculated from the business's financial statements, usually the business tax returns. EBITDA is a business's cash flow, and it stands for earnings before interest, taxes, depreciation, and amortization. So to calculate EBITDA, we must first calculate earnings, which is business revenue minus expenses. We then add back to earnings income taxes that are paid for the business paid for that year, the amount of depreciation that the business claimed that year, and the amount of interest expense the business claimed that year. Most businesses will not have an amortization expense, but if you do, you can add that back as well. This total will give you a business's EBITDA. Try to think of EBITDA as the business's cash flow. For step 2, the bank will calculate the owner's personal cash flow, and that is calculated from their personal tax returns. Now this one's easy. We just take the owner's personal income and subtract the amount of personal taxes that they paid, and that will give us the owner's personal cash flow. So for this slide, on the left side, we've calculated EBITDA, or business cash flow, and on the right side, we've calculated personal cash flow. For step 3, we're just going to add those two cash flows together. We take the business's EBITDA and we add it to the personal cash flow, and we get the global cash flow. This is a total of all cash flows available to pay loan payments. For step 4, to calculate the debt service coverage ratio, banks take that global cash flow figure and divide it by the total of all the business loan payments for the year, plus all of the personal loan payments for the year, including the loan that the business is applying for. A debt service coverage ratio over 1 means that there is more global cash flow than annual loan payments, and there is enough cash flow to pay all of their loan payments. A debt service coverage ratio less than 1 means that there is less global cash flow than annual loan payments, and there is not enough cash flow to pay all of their loan payments. Now, most banks require a comfortable cushion above the amount of loan payments. Now, I can't speak for all banks, but at Central Pacific Bank, we require a minimum debt service coverage ratio of 1.35 times. So if the total loan payments for the year are $10,000, the amount of global cash flow that the business and owner will need is at least $13,500. This cushion is to account for living expenses and unexpected needs like medical emergencies or things like that. So now that you know what banks consider when reviewing your loan applications, here are some things you can do to put yourself in a good position to borrow for your growth. One thing you can do is to make sure that the purpose of the loan request makes sense for your business. Will the funds be used for something that will help your business grow? For example, financing equipment to increase production to meet your growing demand for your product is a good use of loan proceeds. As I mentioned earlier in the 5 C's, maintain your credit score. An owner's credit score is the best indication of their willingness or probability to repay a debt in good times and tough times. I cannot speak for all banks, but at Central Pacific Bank, we look for a minimum credit FICO score of 680. It is also important to know your financial position and maintain current and accurate financial statements. So like Cynthia mentioned, you will need to likely provide current financial statements, an income statement, and a balance sheet dated within 30 to 45 days of your application. It's good to show the lender that you know your cash flow and financial condition. If you don't have this information, the lender might wonder if you know where you stand financially, because these numbers will help you to make business decisions. If you do know your financials and you can show that your cash flow is sustainable and can support the new debt, you can be pretty confident in obtaining financing. Last but not least, be able to share your business plan and what you project for the year ahead. Like Cynthia's presentation mentioned, this shows the lender that you are a good business operator and aware of your industry and economic conditions. Detail the plan on paper, including financial projections with reasonable assumptions that support the projections. You want to be able to show your knowledge of the industry and explain how you came up with the projections, which should be based on data. Your projection should be an educated guess based on sound and reasonable assessments of current and future conditions. Lastly, relationships matter. We recommend that you build a relationship with your banker. You don't have to wait until you need financing. Start working with a banker you're comfortable with because your banker is your advocate. Good communication is important in any relationship, and good communication with your banker is no exception. Share details about you and your business. The better your banker understands your business, the more clearly your banker can articulate your request and how it will benefit your business to hopefully gain approval from the bank. Bankers play a vital role not only in obtaining financing, but good bankers are subject matter experts. So good bankers keep up to date on industry reports and the current business environment. Good bankers are also a good sounding board for new ideas. Sometimes we play devil's advocate just to make sure you are considering all angles of the situation and assessing all of the risks. We've now discussed things lenders consider for loan approval and how to put yourself in a good position to borrow money for growth. The next question you might have is, what kind of financing do I need? The purpose of the loan will dictate the type of financing. Long-term assets requires long-term financing, and short-term uses like working capital require short-term financing. So term loans are a good example of what to use for long-term financing. So examples for uses of term loans would be equipment, vehicles, or fixed assets with a usable life of longer than 1 year. An example of this might be a manufacturing company expanding their facility to increase production, or a trucking company looking to acquire trucks to expand their fleet. Another example would be permanent levels of inventory. For example, if the business is going to carry a new product line, the initial base of inventory should be financed with a term loan. As that inventory sells off, replenishing that base level of inventory could then be financed with a line of credit, which we will cover next. So a line of credit is for short-term financing. So examples would be to cover expenses that would be to purchase inventory. Recently, there have been supply chain issues delaying shipments of inventory. So a line of credit could allow you to order the inventory ahead of time so that you don't run out. You could also use the line of credit to carry accounts receivable. Sometimes construction companies have to wait 30 to 60 days for payment for their work done. A line of credit will allow them to keep paying their payroll while waiting for their receivables to be paid. A business could also pay accounts payable to take advantage of discounts for early payments. Before I conclude, I wanted to make a brief mention about SBA Guaranteed Loans. Sometimes the bank needs an enhancement to approve the loan, and this is when the SBA Guaranteed Loan can come into play. The bank will still make the loan to you, but in addition to your personal guarantee, the SBA will guarantee a portion of the loan. This reduces the risk to the lender, so it is able to make a loan that they may not have made otherwise. Central Pacific Bank is a very active SBA lender, and since 2007, CPB has been recognized 11 times as the #1 small business lender of the year. It's something we're pretty proud of. So thank you for taking your time today, and I hope this will help you to obtain financing to help your business grow. If you are looking for a team of good bankers who understand small businesses and their needs, please feel free to contact me or inquire via our website at cpb.bank.
Thank you very much, Michael. And I do apologize. We ran into some technical difficulties. Zoom is awesome until we ran into technical difficulties. So some of the slides were not moving quite fast enough. So apologize for that. But we'll make sure we get a recording over to the participants of this webinar. I would like to now open it up for questions from our attendees. Again, please use the Q&A button to submit your questions. Okay, the first question I have is for Cynthia. Question is, does the SBDC assist with financing for new business startups?
We can assist you in terms of what resources there may be, and again, the business plan and your ideas, what you need the money for, applies no matter what stage of the business you are. There are just different avenues of funders, like Michael covered in his portion of at what stage of your business when you're starting, what available resources there may be in the community. But generally speaking, there are no loans to start up a business from a financial institution. But there are other means of getting that, and we can point you in that direction.
Thank you. Michael, next one is for you. How long does a loan take from start to finish through the SBA?
So I would say from application to loan funding, it can take about anywhere from 2 to 4 weeks, and it just depends on the loan amount. For loan amounts or line of credit amounts larger than $50,000, tax returns are normally required by the banks, and when the banks rely on tax returns to qualify the loan, the SBA requires the banks to verify those tax returns validity with the IRS, and that can take a little while. So if the bank is utilizing an SBA guarantee, but the loan amount or line of credit amount is $50,000 or less, I'd say it's within 2 to 3 weeks. It can be a little faster, but if it's more than $50,000 and they rely on the business tax returns and personal tax returns, it could go a little bit longer. I'd say maybe 2 to 4 weeks.
Thank you. Cynthia, do you have any recommendations on how to use market research to support a business's financial capacity?
How market research can support the financial capacity. I think that is when you know your market and the industry and your target customer, then that supports your assumptions for the revenue growth. So if you understand that the market conditions, for example, how many competitors are out there? Are you feeling a need that there's no solution for, that you're very unique, that opens it up? Or are you in a market where there's a lot of competitors? Then that would vary. So understanding your market, pricing, positioning, competition, your value, your uniqueness, how you're going to sell, whether it's business to business or business to consumer, all those factors, it's very multidimensional, will help you understand your financial potential. Michael, do you have anything to add to that from a banker's point of view?
Yeah, there's resources out there. There's industry reports, like you mentioned, that can help to show what other companies in your industry are experiencing performance-wise, and also the RMA the Risk Management Association has data on companies based on asset size usually or revenue size. And so you can compare your financial performance with companies in your industry across the nation similar to your size, and you can see where you align near those benchmarks. And it's good to go over with your banker because they can maybe help you to run the business more efficiently or identify points that might be your strengths or that might be hindering your business performance. And so, those are good resources to have.
Michael, question for you is, how does one look for a banker to build a relationship with?
You just got to meet a lot of bankers, unfortunately. You got to try to find someone you like. And so, every banker's different. Every banker's got their own personality and their own work style. And so I would just recommend meeting as many bankers as you can and finding one who understands you or, is compassionate or maybe is an industry expert in whatever industry you're in. But I mean, there's a lot of us out there. So, and it's not one size fits all. You just have to visit multiple banks, I think, and just, tell them about your business, tell them about you, and find one that you think understands you and will be a cheerleader for you and a supporter of you and your business.
And Cynthia, any other valuable partners should businesses consider besides a banker?
Yes, absolutely. You should always have your team of trusted consultants or advisors, such as your attorney, your CPA, and insurance. You can add on there your business advisor. Things like there's many resources in the community to support small businesses at no or little cost. And belonging to some industry groups of your industry, so you can keep tabs with what's happening. That's a really good source. Say if you're in the restaurant or the many building industries, there's many associations. And if not, there's also, generally speaking, the chambers of commerce, because they advocate for small business.
Great, thank you. Michael, we have a request for you to kind of touch upon the line of credit versus business term loan. Approximately what's the interest rate like for the two products typically, and what the timeline looks like for I guess, repaying those types of loans.
So, to hit the first part, interest rates are usually a little cheaper on the term loans than lines of credit. For the uses, what you want to use a line of credit for is something that you can pay back with normal business cash flow within a year. And if it's going to take you more than a year to pay down whatever you draw from that line of credit, you probably shouldn't be using it for a line of credit. That's a concept called misfinancing. So that would be like the equivalent of, say, buying a car on a credit card, because your business line of credit is kind of like what it is like a really cheap credit card. It revolves like a credit card. You can draw from it and pay it back. Only the business line of credit, you're looking at an interest rate somewhere probably between 6 and 8%. Whereas a business credit card, you're paying anywhere from 15 to 30%. And so it's just a cheaper version of a business credit card. But you wouldn't use your business credit card to buy a car and then make monthly payments for that credit card, because the interest is just going to eat you up. And so that you should finance it with like a term loan, which is an auto loan, right? So you should really think about the use of what you're intending to draw the line of credit if it's for a fixed asset, it should probably be a term loan. It probably shouldn't be the line of credit. Or again, how fast could you pay it back? If you can draw from the line and pay it back within a year, that's probably an appropriate use. But if it'll take longer than a year to pay that line of credit back, you probably should be looking at a term loan.
Great, thank you. Cynthia, question for you. What if the reason for my business's success is me personally? How do I keep my business successful if I'm not the one performing the daily services?
Yes, that's a growth pain, right? When you are running it, you're solo and you want to expand, but how do you first know how you can delegate and then hire the right people or form the right team that can cover the areas that you need assistance with? So you look at, it's a combination of understanding your process, understanding what are the strengths that you have that you want to utilize and keep involved in your business. You're the brand, and other areas of how you want to structure strategically your operations. So that's another area besides business plans that we can work with business owners like yourself to have that kind of discussion and look at your operation process as well as human resources issues and leadership as well. I hope I addressed that question appropriately.
We're getting tons of questions, very exciting, so I'm trying to get through as many as I can. I appreciate everybody's patience. This next question is regarding, do we have the ability to separate personal finances from business finances? So if I or my family member had to file for bankruptcy due to, an unforecasted situation, and so my personal credit score is impacted, can I separate it from my business when applying for financing?
Probably not. That's the hard part, is that, like I mentioned, the FICO score is really that's the best indicator of a person willing to pay. And the banks are in the business of making performing loans that get paid back. And unfortunately, when you claim bankruptcy, what it tells banks is that, although you had an unfortunate situation, you maybe didn't make good on some of the loans or credit cards or other credit facilities that you had obligations to, and they got charged off with that bankruptcy. And so it's seen as a risk. And banks are in the business of making good loans, not bad loans. So we don't want another 2008 financial crisis. And so we're held by the regulators and auditors to make sure that we make good loans. So it's hard. You'll probably just have to wait it out, unfortunately.
Cynthia, any thoughts that for someone in that situation that you would like to add to?
I guess that would be, there is exactly what Michael said. I think when you're in that situation, so if you were to say in hindsight, what we've always kind of encouraged people to do when you're doing your business is start off from the get-go, from the beginning, to make sure that everything is separate. That when you do have business expenses, that you keep it under your business accounts, your business credit cards, your business loans, your business bank accounts, and then personal separate. However, we do understand that when you're a small business, many times, you have to be the guarantor as well, so you're personally liable. So, but as long as you can keep it separate when you're restructuring, I think it's easier than if you had in the beginning not kept record keeping where all your business and your personal are very clearly separated. And if you were to do a personal loan to your business, that it is appropriately documented and not just, I put in money, but through your bookkeeping and ledger systems and all that, there is a track record. So when you're restructuring or going through bankruptcy, it is easier to separate.
Mike, at what point in the application for a business line or loan is there a hard credit inquiry? And how do you suggest shopping around without a bunch of hard credit inquiries occurring? And what kind of things should we consider when shopping around for a institution to get financing from?
So the first question, as soon as you submit the application, that will be probably the first thing that the bank will do is to pull the hard credit inquiry. So you're right. You know, you don't want to put too many applications in at once because the number of hard inquiries will detract from your credit score just due to the amount of inquiries. So kind of in the following question, how would you decide on which bank? I think I would talk to other business owners, and that's where the trade organizations, or even just your supply chain, your people you get, you buy inventory from, businesses you sell to, your neighbors. I would just ask openly, like whether they like their bank or what they like about their bank, and just interview a lot of bankers, and you should, after talking to 3 banks, you should kind of get an idea of what each bank's kind of philosophy is toward small business banking, and what they do to promote or support their customers, what kind of services that they do, whether it's consulting with the businesses, so you just have to kind of interview a lot of banks and see which one you think will help you and your business to your expectations.
Thank you. The next question is, how long do I have to be in business? So, perhaps I don't have a business score yet to be able to apply for a business loan. And at what point oh, can you hear me okay?
Yeah.
Okay, great. So the question is, how long do I need to be in business if I don't have like a business credit score, for example, to be able to apply for a loan? And at what point do I not need to co-sign as a personal guarantor?
So you can apply for a business loan as a startup. We do startup financing. So you don't have to necessarily have a business score. Most banks rely very heavily, and it's the personal FICO score is what's weighted probably the most. So that's why it's important to protect your credit score. Also,
did we lose Michael, Cynthia?
Yes, I think so. Even for myself, I was off for a little bit, and so I didn't hear the last question. But could I expand on the previous question about how do you find the right banker and if credit pulls will affect the score? I have a suggestion how we work with clients while Michael is getting back online.
Sure.
So in that, when you work with SBDC, we will work with you, look at your financials, and then you can pull your own credit score. So if you have a credit card, you can get a free report, a personal credit score report once a year. But also many times now, the different credit card companies offer that as part of their service, and they tell you what your credit score is. So rather than pulling a hard one once you go to the bank, we will work with you, see what your needs are, kind of guide you. And then through using those 5 C's that Michael said. And if you have a bank that you already work with, we kind of say continue that relationship. Even if you have a personal bank account there and you're just starting off your business, then you can visit there. Or perhaps it could be based on where your location is. So perhaps you might bank with one bank in your business location, and then one at your personal, for your purses at another location, another bank. That's fine, because say in your business location, the bank that you have your personal banking with is not as conveniently located, especially if your business has to get change for, your cashiers, or just depending. And then the other thing you want to think about is the savviness of the different financial institutions where online banking, as more e-commerce is doing. So you, besides just the friendliness and the connection that you have on a personal level with different bankers, you want to look at the full services that each lender has. Many times, especially now, if you're using QuickBooks or Square or any other types of online payment services, you'll get emails saying, do business with us, we can give you a line of credit, we can give you a loan. A cautionary tales is look at it, see what their rates are, because there's nothing more useful, especially when we're in Hawaii, when you have a situation or unforeseen, that having your relationship with a local bank really helps than waiting online with an 800 number for someone to service you. Just promoting our local banks here, but that's how you can determine service, the needs of your business, convenience, and reaction. If you don't have a banker, we maintain a lot of relationships with other banks in Hawaii. I used to work at a bank, in fact, a few of them in the community. One of our other senior advisors has been a long-time banker. So we have banking experience. We can see it from both sides of the desk, so to speak, as a business owner as well as a banker. We help prep you. So once you go to 2 or 3 lenders, it might be requesting just an inquiry, not a formal application yet, just to see what kind of services there might be. And we help guide you, and we can be part of those initial meetings if that will help you feel more comfortable as well. So Michael is back, and so he can answer that other question.
Sorry about that. Yeah, and so to answer the question about, is there a point where a personal guarantee is not factored in, and that is very rare. I'd say it's less than 1% of the time when a business owner with 20% or more ownership in the company doesn't have to provide their guarantee. Maybe nonprofits, because there are no owners, but lending to a nonprofit is hard, because based on the nature of the nonprofit, they usually don't have a lot of profit. They're usually running break even or at a loss every year. And so it's very hard to lend to those people, types of organizations, because they're running a loss. And so how are they going to pay the loan back? So it's challenging. So I would just count on having to use your personal guarantee for most business loans, if probably all.
Yeah, and depending on your loan, the amount, the purpose, sometimes your personal assets might be used as collateral, right? Like could be as well.
Could be, but we'll probably still take your guarantee.
Yes.
Yeah, it won't absolve the need for you to personally guarantee the loan. So.
Well, Mike and Cynthia, we still have so many questions. So with your permission, can I run over a little bit just so I can get through a little bit more? Thank you so much. Next question is, if a business has multiple owners and one owner has great credit score and the other one doesn't, does that mean the business will be less likely to receive financial facility?
I can't speak for all banks. For Central Pacific Bank, I would just encourage them to apply. Just never know how that score is going to turn out. And I mean, the worst the bank can say is no. But some banks, they go with the highest FICO score. Some banks go with the lowest FICO score. So I would just, go ask the banks what their criteria is for decisioning those types of applications. And yeah, it just depends on the institution.
Cynthia, for the SBDC, are there business grants available?
The SBDC does not provide grants or financing, but we have resource partners that may have programs that are for specific target industries that perhaps DBED, or DBED is the state economic development, or the federal government may have. But generally speaking, business grants, it depends. So it depends on many factors. If that person has a more specific situation, I'd be happy to, answer their question offline. But generally, if you're looking for a federal government grant, you can go to grants.gov. If you're looking for small business types of economic stimulus, then usually the city and county of Honolulu or the city and county of your county might have some economic development programs in place. A lot of focus is on agriculture, but not just the farming, but also taking that product, Hawaii grown product, into a Hawaii made product. And then there's, exporting that the state of Hawaii DBED, Department of Economic Development and Tourism, and also for high tech. So high tech, there might be some things that is available through the HTDC. So I know there was a question about where can we get these handouts. We'll be providing them to Shireen and CPB, that they can, there'll be a resource list that I can include that you can send to everyone with this kind of information. The handouts from my portion, the and list of resources to help you.
Thank you so much. Question for Mike. How might educational or student loan history impact our ability to borrow a business loan?
The student loans don't really factor in too much. I mean, for most loans up to 50,000, loans or lines of credit up to 50,000, it's just pretty much credit score. Over 50,000 is when you do that cash flow where they calculate the global debt service coverage ratio, and that's when the student loans will factor into that, business and personal loan payments. And so, what we do at Central Pacific Bank, we pencil out the debt service coverage, if the applicant wants, before submitting the application. So you don't have to, like Cynthia mentioned, right? They're a resource too, where they can do a dry run on the kind of the calculation that the banks will go through, because they have experience working at banks. Or you can contact us, and our business bankers will be able to pencil out what the calculation would look like, so we can give you an indication of how likely you are to get approved. And so it would just take knowing what your student loan amounts are. I know sometimes it can be 1, or there could be like 20, and so it'd just be a matter of getting those figures in and penciling out the debt service coverage ratio.
Thank you. Cynthia, how often should I review or redo my business plan?
It depends on the stage. So I would say an overall strategic plan for the next 3 to 5 years, and then annually look at it to see if you're on track with what your vision and your mission is. And then it kind of works backwards, that you always have to check at different levels. And then there's quarterly and monthly key measures, key performance measures that you want to keep an eye on. What I mean by key measures is if you were, for example, a retail store and you notice your inventory, you don't want to just do it annually. You want to keep track and seeing how much of your inventory is moving and how much isn't. You don't want to keep it in your storage too long because it could get obsolete or no longer. So you want to make sure that you're looking at your business plan for different reasons and have dashboards or KPIs or key performance indicators. So it's not just working in the business, but there's certain things that you can look at, the data that your business performs in terms of numbers that can give you some indicators. So that's all part of what I would say a comprehensive strategic business plan, and measurements are crucial when you have a small business.
Well, again, thank you very much, Cynthia and Michael, for your time today, your knowledge and expertise. And I want to thank all of the attendees for joining us today and for really being the backbone of our economy. It's a tough job being a small business owner, and we appreciate what you do. Thank you, and have a wonderful rest of your day. And please be on the lookout for the webinar recording. Thank you.
Thank you, and thank you, CPB, for hosting this. Awesome.